Hi everyone, welcome to this webinar organized by Standard Chartered Bank. The idea today is to provide you a walkthrough of the different aspects of the IBOR oscillation journey with particular focus on the trade finance facility. Can you move to the next slide, please? Thank you. For the next hour, me and my colleagues will look to touch upon the work our bank has done to prepare for the IBOR cessation and hopefully walk you through the key milestones that have already been achieved and what the roadmap looks like over the next few months as we get closer to the 1st Jan 2022 date. Let's move to the next slide, please. On the agenda, we will introduce the move away from IBOR to risk-free rates, or RFRs as we call them. We will then cover the development in the RFR market with the progress made on publishing of term RFRs, as well as touch upon some of the alternative credit sensitive benchmarks, which will continue to develop and something that we will continue to monitor to see what their development and what their progress looks like. We will then spend some time on our RFR capabilities and then do a deep dive using some examples to walk you through what the pricing construct looks like when we move from term RFR, when we move to term RFR based pricing. We will then spend a few minutes on the next steps, which are critical to ensure that the bank can continue to support your business requirements in a post-IBOR pricing world. I also like to inform you that we have a Q&A window available where you can type in your questions throughout the session, and we will look to answer all of them during the session itself to the extent we can. Where we can't, we promise to come back to you with an updated document where all the questions asked during this session are answered. Just to remind you again, the Q&A small pop-up button is on the right-hand side of the screen available to you. Please feel free to type in your questions through the session, and we'll look to answer as many of them as we can during this hour. With that, I'd like to pass it to my colleague David, who will walk you through the next few slides. Over to you, David.
Yeah, thanks, Abhishek. Hello to everyone. Thanks for joining today. By way of introduction, I work as part of the group compliance work stream, focusing on LIBOR transition from a conduct perspective. So the key objectives here, we've got to inform you of the upcoming LIBOR transition milestones, provide an overview of the latest developments on forward-looking term rates, and as Abhishek mentioned, the key difference between term RFRs and LIBOR pricing, and then also provide an overview of the bank's term RFR capabilities. Obviously, the kind of key purpose here is to help ensure that you're clear on the next steps, and obviously ensure you're up to date with the bank's engagement as we move closer to LIBOR cessation. Can we move to the next slide, please? So in terms of the key milestones, so from the 31st of December this year, the IBA will cease publication of most LIBOR settings, effectively bringing to an end the benchmark's 36-year run. The publication of most LIBOR currencies and tenors will cease or be deemed non-representative after the 31st December this year, and that's including the 1-week and 2-month US dollar LIBOR tenors. Publication of US dollar LIBOR for the other tenors, that's the overnight 1-month, 3-month, 6-month, and 12-month tenors, will continue until the 30th of June 2023. So, in addition, from the 31st of December this year, Standard Chartered will cease entering into new US dollar LIBOR transactions other than for risk management purposes. As such, clients should switch to trading SOFR or an alternative reference rate as soon as practicable, and again, in any event, no later than 31st of December. So to date, the bank's prioritized remediation of non-US dollar LIBOR exposures, and as mentioned, as US dollar LIBOR will continue to be published for most settings until mid-2023, we'll look to remediate these positions in due course, starting from early next year. Finally, it's also worth noting that Ionia would be discontinued on the 3rd of January 2022. The risk-free rate alternative recommended by the Euro risk-free rate working group for Ionia is the Euro short-term rate, or ESTA, and clients can obviously still continue to use Euribor, for which there are currently no plans in place to cease. Move on to the next slide. Thanks. So one of the biggest concerns in light of LIBOR's forthcoming cessation has been the availability of forward-looking rates. for which regulatory and industry groups have both recognised a need for in specific areas of the market, and that obviously includes trade and working capital products that require a forward-looking rate for discounting. Specifically, the FICC Market Standards Board, or the FMSB, have produced a standard on use of term SONIA reference rates, and in the US, the Alternative Reference Rates Committee, or ARC, have also published recommended best practices for the use of term SOFR. So the development of robust term rates is obviously dependent on underlying volumes in risk-free rate derivatives markets. And given that we're seeing some increasing liquidity here, I'm now going to provide some details around the term rates currently in existence. So as we can see from the slide, term RFRs are currently available for SOFR, SONIA, and the Tokyo Term Risk-Free Rate, or TORF. The CME Term SOFR was formally endorsed by the ARC in July this year. Term SOFR is obviously going to also play an important role as part of the ARC recommended fallback waterfall and as part of the current New York State legislation for tough legacy contracts. In terms of term SONIA, so two different SONIA term rates are currently in publication by the ICE Benchmark Administration, IBA, and Refinitiv respectively, and they're available in the 1, 3, 6, and 12-month tenors, same as for term SOFR, although TORF is currently only available in the 1, 3, and 6-month tenors. The calculation methodology for Refinitiv and IBA term SONIA both use a waterfall-based approach, which is based upon SONIA OIS order book data, which differs slightly, but produces a similar rate. So for example, the IBA rate is based on data from 3 interdealer brokers during a 120-minute window. The Refinitiv rate is based on data from 2 interdealer brokers during a 20-minute window. The Sterling Risk-Free Rate Working Group have published a comparison of the two rates, which we're able to provide if anyone as part of the call is interested in further details. Although the Sterling Risk-Free Rate Working Group has not formally made a recommendation in respect of any particular term SONIA reference rate, the FCA did confirm that the IBA rate will form one of the components in synthetic Sterling LIBOR in its recently published draft notice of requirement. In terms of ESTR, Refinitiv and IBA have published details on methodologies for a prospective ESTR term rate, and the bank is following any developments on this as they're released by the Euro Risk-Free Rate Working Group. As for SARON, the lack of liquidity here means there's currently no intention to publish a term SARON as confirmed by the National Working Group on Swiss franc reference rates. Move on to the next slide, please. You understand that some clients have asked about the development of credit-sensitive rates in their discussions with frontline colleagues. The first point to make here is that the bank supports the adoption of risk-free rates as the preferred alternative rate, in line with much of the regulatory and industry guidance which I've referenced previously. So as we can see from the quotes provided on the right-hand side of the slide, both UK and US regulators have struck notes of caution in respect of the use of credit-sensitive rates, citing, among other things, concerns around their robustness in terms of market stress. In terms of the existing credit-sensitive rates that are available, the 4 main rates that have emerged are Ameribor, which is produced by AFE, Bisbee, produced by Bloomberg, the Bank Yield Index, produced by ICE, and the Credit Inclusive Term Rate, which is published by IHS Markit. As stated, we currently have no plans to offer credit-sensitive rates, but will continue to track and monitor industry developments in this regard. I'll just hand you back to Abhishek here, who will take you through the current RFR capabilities within transaction banking.
Thank you, David. Could you move to the next slide, please? I just wanted to spend a few seconds on this slide, which basically talks about the term RFR. It's a continuation of the point that David just made. And the bank has built in the necessary capabilities to provide a full suite of term RFR cash and trade product capabilities. So for GBP, term SONIA, JPY, TORF rate, US dollar term SOFR, and for euro, transactions can continue to be based on the Euribor curve, which we always supported and will continue to support, as Euribor is a benchmark which will continue to be available for pricing transactions. So we've built in the necessary system capabilities to allow us to transact with our clients using these term rates for the respective currency. Can we move to the next slide, please? Thank you. I think this is an important slide, and I'll kick this slide off before I pass it to my colleague Gautam, who will be the next speaker to take you through the next few slides. Essentially, this slide talks about some of the key differences which exist between the current LIBOR curve versus the new term RFR curve. As the name suggests, RFR refers to risk-free rate, which means they don't have any liquidity or credit spreads built into it, even though we have a term looking forward structure. So I think this is an important point, that while there have been developments in the RFR market that allow us to now have a tenor-based curve similar to LIBOR, i.e. 1 month, 3 month, 6 month, 12-month points, but these continue to be RFR-based pricing, which means risk-free pricing. So you could have a 3-month term RFR, but that would still be a reflection of the risk-free rate and not include any embedded credit or liquidity spread like a LIBOR does at the 3-month point. That's why, as you can see, as it's been graphically depicted, the blue box which says LIBOR becomes a much smaller gray square or gray rectangle block as we move into term RFR. And that's to state that the credit in any term liquidity risk premium will not be a part of the base rate anymore. That means it will be embedded into the margin that ensures that the all-in pricing levels continue to be at the current levels, that allow us to move the benchmark away from LIBOR to term RFR, but allows us to price our clients in a pricing which is consistent to what today it looks like under the IBOR market scenario. So that's, I think, the key takeaway in terms of what the difference in terms of the construct will look like. And that's probably a good segue for me to introduce Gautam, who will probably add a couple more points on this slide and walk you through examples which explain these constructs and the nuances between the two in a lot more detail moving forward. Over to you, Gautam.
Thank you, Abhishek, and good evening to all of you who have joined us. So just continuing on from what Abhishek mentioned, and it is quite important for us to kind of reiterate the key difference between LIBOR and RFRs in general. LIBOR is a forward-looking rate, which means you have a clear-cut term structure that gives you the forward expectation of what rates are going to look like in the future. Whereas the RFR rate as such is purely an overnight point. It is derived based on transactions that have already been executed in the market in the previous trading day. So the rate that we have in the overnight market is essentially just valid for 1 day. And based on the fact that for trade finance in particular, we have quite a big dependency on forward-looking term rates. Of course, regulators have kind of responded to that request with the creation of these term rates that we have. As a bank, we have obviously adopted those forms of pricing in our systems, and the pricing construct that you actually see around over here is how we would be looking to price going forward. In the next few slides, I will take you through some of the examples, but the key point over here to also note is that purely from a pricing construct perspective, it is still going to remain as two components. One of them will be the benchmark and the other one would be the margin component. Now, of course, with the fact that LIBOR does contain embedded in it certain credit and risk premia, as Abhishek also mentioned, the component of LIBOR in the entire pricing was a little bit more significant. As we transition away from LIBOR, term fee rates being pure market expectations of what the interest rates are going to be in the future, they are typically going to be trading below what the LIBOR rates would be because they do not contain any of these credit, term, or liquidity risk premium. Those will now feature as a part of the margin itself. And in order to maintain the economic equivalence between these two, these risk premia will be a part of the margin. If you could move to the next slide, please. Thank you. So over the next couple of slides, we're going to take you through some illustrative examples that we have. The first one over here being a case of a credit bills negotiated, where we are looking at a CBN for a 6-month tenor if it was priced today and what it would look like once it's priced after the IBOR cessation. So you might be quite familiar with the current pricing. Given that it's a 6-month asset, we would be looking at the 6-month tenor point inside the LIBOR curve. That in this particular example stands at 16 basis points. We have the margin that is at 50 basis points. and the sum total of those two is the all-in price that we would be pricing on. As we transition away from LIBOR, the first thing that you can see is the construct as such kind of remains the same. The components still do remain the same. You still have a benchmark, and we still have a margin over there, and the sum total of those is the all-in price. Now, what's changed over here, of course, is the fact that the benchmark is no longer LIBOR, and it's the Term SOFR benchmark in this particular example because it's on US dollars. That kind of stands at 5 basis points because, as I just mentioned a few moments back, the rates that we are looking at for in the term RFR market, they are purely risk-free rates. They do not contain any credit or risk premium. Consequently, and to maintain economic equivalence in pricing, those would form a part of the overall margin quoted. Sum total of those two in this particular scenario shows up as an all-in price of 68 basis points. The similar pricing concept will apply for all of the other published tenors, like if it was a 1-month asset or a 3-month asset, so on and forth. We would be looking at the actual published rate as such, and the margins would obviously be reflecting the pricing for that particular tenor. If you could move to the next slide, please. Thank you. Over here, we are going to take you through an example of in a typical product that's covered under the bank facility letters. We are looking at an example of an IIF, which is again priced at 6 months, just to maintain the consistency through some of the examples. Over here, again, the pricing as such, if you're looking at the 6-month tenor point, we have the LIBOR rate quoted out over there. And we have a total margin quoted, the sum total of those being the all-in price that is provided to us, and something that you're also familiar with today in the pricing world or in the pricing constructs that you are typically transacting in. Now, how does this price up when we transition into the post-IBOR world? We have taken 2 scenarios over here because there can be multiple drawdowns that can happen in a particular facility agreement. In the first example, we are assuming the pricing is, or the drawdown happens on 15th of April, 2022. The pricing is again for a 6-month asset. So we will be looking at the 6-month term SOFR rate, which is at 5 basis points. And we have the overall margin quoted over there at 81 basis points. The sum total of it being the net all-in price that where the interest would be paid back to us upon disbursement of or upon closure of the loan. Now, the same example where we are looking at a drawdown, not on 15th of April, but a subsequent drawdown on 1 month down the line on 15th of May. The pricing construct again as such remains the same, but the only variable component around over here is the 6-month term SOFR rate, which has moved by 1 basis point. And that is pure market dynamics based on which the actual pricing would work. So consequently, you would see the all-in price change by about a basis point in this particular example. Now, what do we do about scenarios where the rates are not as such of a published tenor? Because as David had mentioned earlier on, the term rates that are being published in the market are for very select few tenors. Typically, they are for the 1 month, 3 month, 6 month, and in certain cases, they are all for the 12-month rates also. So if we were to look to price, let's say a transaction which is falling anywhere between 1 and 6 months, a 4-month example that we have over here, how would that be priced? The margin component as such would remain constant as it's already been agreed inside the facility agreements, whereas the actual benchmark rate, because there is no published benchmark rate for a 4-month term SOFR as an example, these would be linearly interpolated typically. Of course, if you are looking for any other pricing methods, please do get in touch with your RM, and we are more than willing to discuss the options that are available. Similarly, if we have a pricing that needs to be done which exceeds beyond 1 year, how would that pricing look like? As mentioned before, these term rates are typically available only for short tenors, which is 1, 3, 6, and in certain cases 12 months. The market as such that prices anything beyond that, beyond the 12-month point, would typically be reflective of the IRS rates in the market, which is typically how the market curves are kind of constructed. And of course, there are additional internal methodologies that would also be a part of that pricing. If you could move to the next slide, please. Thank you. Now, in this particular example, or rather up until now, what we have been talking about pricing is in the sense of fixed rate transactions in a way, which means that right at the inception of the transaction, the rates get locked in and they remain constant throughout the entire period of that particular drawdown, and they are not changed. They do not change till the drawdown actually matures. What if we have a same transaction, but over here, or a similar transaction, but over here the benchmark is variable and it resets periodically for the life of that drawdown. So this is the same example that we are using, but over here you're quite familiar with the LIBOR construct. The LIBOR rate would reset on its pre-designated reset dates. That same concept again applies over here with the term SOFR market or the term SONIA market. So over here, we're looking at pricing an asset, a 6-month import loan that has a monthly reset, and it starts from March 2022. Right at the inception of that particular transaction, we know we have full visibility of what the 1-month term SOFR rate is. We, of course, know the margins that are already contractually agreed. The sum total of those two will give you the all-in price. But what happens on 1st April, 1st May, so on and forth, to the life of the drawdown? As you would notice on the table to the right-hand side of the slide, the margin over there remains constant through the drawdown period itself. So for the entire 6-month period, that margin remains locked in. The only variable component over here is the 1-month term SOFR rate, which would reset itself at the beginning of the next interest calculation period. Consequently, the variability in the net price that is being charged would also reflect around over here, depending on, of course, where the term SOFR rate would be at that particular point in time during the reset. I would now take an opportunity to pass it on to my colleague Ashita, who will take us through some of the FAQs. And if you could move to the next slide, please. Thank you.
Hello, Gautam. Thank you so much. Hi, everyone. What we're going to cover is these FAQs, or frequently asked questions. This, of course, is an offshoot of the examples that Gautam has gone through with us in detail regarding different products. So I'm sure we can also see in a couple of questions in the panel that will the all-in rate change if we use term SOFR? Yes, the all-in rate will change, but a term RFR based all-in rate is expected to remain similar to the margins to the all-in price that you must be seeing as of today when you're quoted on LIBOR plus the margin pricing construct. So yes, the all-in rate will be similar. Will term SOFR, which is the new benchmark that we will be using, be market discoverable? Yes, term SOFR rates are published on the CME website. We're taking an example of a transaction where the bank has discounted a US dollar LIBOR LC prior to December 2021 with the maturity in 2022. That is, Standard Chartered Bank will only receive the principal payment from the issuing bank in 2022. Will such a transaction require any remediation as of today? No, this does not require any further action or remediation from your end, as the rate that we had discounted the LC has been locked in prior to the cutoff date of 31st of December 2021. So we will proceed as per BAU. Can I book a floating transaction using term SOFR? Yes, we do have the capability to offer floating transactions using term SOFR, and that's just the example that Gautam went through us in detail, where we have a 6-month transaction with a monthly reset. Another question I'm sure is at the top of your mind is, what about existing transactions and agreements? So for transactions which have been booked prior to the cutoff date for US dollars, specifically I'm mentioning, prior to 1st of January 2022, they will continue as it is as long as there is no reset. For US dollar transactions which have a reset option, but as long as they mature before 30th of June 2023, they too will continue as per BAU, and no remediation is needed for them at the moment. Is it possible to book a trade transaction with a reset option for the currencies which I'm mentioning, which is GBP, JPY or CHF in Q4 2021 using the IBOR benchmark? So if you want to book a reset transaction for any of these currencies in the next 2 months, we will not be able to offer US dollar, we will not be able to offer IBOR benchmark, and the pricing will be based on the corresponding term RFR or alternatives for these currencies. Similarly, can we book a trade transaction with a reset option in US dollar in Q4 2021? So yes, we can book a US dollar transaction based on IBOR in Q4 2021, basically till 31st of December 2021. But we recommend that because we are going to see a cessation of USD LIBOR, we should start moving our transactions to term RFR as soon as possible and practicable. Maybe please go to the next slide. Thank you. So a couple of key takeaways from this conversation has been that we need to remember that there will be no new US dollar LIBOR transactions being booked after 31st of December 2021, as long as the letter has been, that means any new letter that is being signed in 1st of January 2022 will not be offering transactions on new US dollar LIBOR. The clients should start switching to RFR or term RFR as soon as possible. And we as a bank have developed a full suite of RFR capabilities. As you have seen through this presentation, we've shared different examples of different products which can be priced on term RFR, which cover your trade product suite. I'm sure our relationship manager must have reached out to you, and you will keep hearing from them regarding the bank's offering, regarding the new alternative benchmark rate and what we're offering. Please note that some term RFR is risk-free, as it is risk-free rate. They are expected to have lower interest rates than term LIBOR. This credit and liquidity premium, which is not a part of the term RFR, will now be blended into the margin to retain economic equivalence between LIBOR and term RFR pricing construct. Maybe move to the next slide, please. So next steps, or what should you be expecting from us? We must have already engaged with you to discuss any of your outstanding contracts or transactions which you must be having with us in GBP, JPY or CHF LIBOR, which are being impacted by the LIBOR cessation. Basically, these are those kind of transactions which have been booked for these currencies, and they have a reset option in 2022. So if you have any outstanding like that, you must have already heard from us and from your RM in detail. No remediation is needed for any of the existing transactions that have been booked in 2021 on USD LIBOR with no reset option, and they will continue as per BAU. Starting from December 2021, you will start hearing from us regarding the renewal of our US dollar LIBOR facilities, where we will talk to you about the new alternative benchmark rate and the revised margin for your trade facilities. I'll hand it over to my colleague Abhishek to take us forward.
Thank you, Ishita. Look, I think just spending a few seconds on this slide, I think this is a really, really important slide. And by the way, I see some questions coming in which you're looking to answer. So thank you very much for all the questions. Keep them coming. We hope to answer as many of them as we can over the next time that the minutes left on the conversation. While those come in, the next steps, yep, I think very important to ensure that we engage and we hear from you, our clients, if there are drawdowns in these four currencies, i.e. GBP, JPY, CHF, or Euro. Euro, if it's pricing and the documentation and the pricing is on EURIBOR, then there is no remediation because that can continue as we spoke of earlier. In cases where the underlying documentation carries the word Euro LIBOR, those I would recommend reaching out to respective RM's frontline teams so that we can work with our clients and make sure that we do remediate the underlying documentation before end of the year so that we can price our clients effectively from 1st Jan on the correct benchmarks, which is EURIBOR for Euro and the term RFRs for the other currencies. Again, for transactions booked within 2021 on US dollar LIBOR, the maturity dates and the other dates mentioned here are clearly very, very important, because from 1st January 2022, the regulatory guidance is very clear around no additional US dollar stock, which means any new facility executed from 1st January 2022 for US dollar will need to be on term RFR. where US dollar LIBOR continues to be available only to support the runoff of the legacy existing contracts which existed in 2021 or before that. All new contracts, new facilities executed from 1st Jan 2022 will have to be on the new benchmarks of term SOFR for US dollar. For the other currencies, it's a slightly more straightforward conversation because there is no IBOR from 1st January 2022, which means all facilities, new ones that we enter, will have to have the RFR language, as well as existing facilities that our clients have with us will need to be remediated and moved over to RFR if the underlying documentation carries IBOR-based pricing language. As also mentioned, they start to see a lot more communication around the usage of US dollar LIBOR and what transition to new benchmarks looks like. So please keep an eye out, and for our own internal staff as well as for our clients on the call, you will hear through the necessary right forums through your RMs or through other means that the bank will contact you with, providing you necessary guidance, information, and on-ground RMs to work with you to make sure your dollar contracts with our organization correctly reflect the language that should be carried going into January 20. Those would probably be a few key points I wanted to add on this slide. Can we move on to the next slide, please? Thank you. This is an important slide. As I mentioned, as much as we try and provide answers on this call, there could still be further questions which come, and that's absolutely all right. So please note the email address where you can reach out to us. Of course, I would still encourage the first port of call on any queries should be the respective RMs who will work with you and provide you all the necessary details around pricing, redocumentation where it's applicable, to ensure your transactions, our clients' transactions with the bank continue to happen in a smooth manner like they do today. We also have shared some other additional resources which will provide you with reference material, which will give you additional context on everything that we have spoken about so far, so that you can get the necessary details. So we will be sharing these details through this deck later on, and hopefully these will be available for you to take a read at your leisure and come back to us if you have any more questions for us. Next slide, please. All right, thank you very much. We are at the Q&A section, and I've seen some questions come through. If I may use the opportunity to run through some of these questions so that even if you have not asked them, it'll be good to cover those because you might have similar questions, and it'll be good to walk through those. The first question was around when will term SOFR be available for use? The term SOFR from a system capability perspective is ready for use. We have the necessary licensing and documentation in place that allows us to use term SOFR now. And please feel free to reach out to respective RMs and to our internal staff on this call. Please feel free to reach out to your respective clients and engage them around actively moving existing facilities over to these RFRs, and we will have the necessary support provided in terms of pricing, redocumentation, to ensure that as and when our clients are ready, we are able to move them over to RFR in line with the regulatory guidance and the dates that we've shared with you. The other question from Mark was around what happens to the SOFR in compounding in arrears. Gautam, do you want to just provide some insights on the compounding with arrears pricing methodology, please?
Sure. Thank you, Abhishek. So from our perspectives and our preferred approach to pricing, now that we actually have term rates that are forward-looking in nature and give the necessary visibility of borrowing costs, we are looking to adopt term rate pricing as our default pricing for most of our products. Now, if you are looking very specifically for a compounded in arrears methodology or anything, then I would request you to, of course, reach out to your RM. We can have a slightly more detailed discussion on how the overall what the product is and how its pricing needs to look at, and then we can work out a solution with you on that. Thank you, Abhishek.
Thanks, Gautam. There's a question which asked about one of the examples where the overall pricing went up a bit. Look, that is possible. As you mentioned, the idea is to keep the overall pricing at similar levels. As you would appreciate, these are market curves, and as the RFRs and IBORs continue to trend and move forward, and we see more and more liquidity coming into the RFR and liquidity reducing in the IBOR benchmark, those will be recalibrated from time to time to ensure that the all-in pricing levels remain consistent. But as they are market curves, they would be subject to usual market volatility that we see with any other market curve. So you could have cases where there is a 1 to 2 basis point differential in the overall pricing, but that's in line with how the market benchmark curves are moving forward and how they're being adjusted. The next question is, can we be sure that the adjustment for margin will be seen for loan and any corresponding interest rate swaps? So on the loan bit, I can answer that piece that yes, there will be, the adjustment will be consistent with the examples walked through, where the differential in the benchmarks will be used to adjust for the margin. On the derivative in terms of interest rate swaps, I would say we will need to understand the details a bit more to make sure that the pricing is consistent. But the underlying principle is to ensure that the all-in pricing that we have continues to be at similar levels as we move away from IBOR into the RFR rate construct. So that principle does not change irrespective of the product we transact with. On the derivative market, as you can imagine, there are fairly detailed prescriptions resourcing available, which should be read to understand how the pricing for derivatives moves forward as we move away from LIBOR. There's a question from Shah Jahan. There were additional 2 basis point all-in cost if you use SOFR on the last slides. I presume you're talking about one of the examples, Shah Jahan. I would make the same point again, that that's in line with the same answer that I gave, where you could have potentially, as these are market curves, looking at the different tenor points as LIBOR moves and as RFR transactions move, we could potentially see some divergence. But the methodology to ensure that we compare these over a period of time and ensure that we use an average to adjust for these, that methodology, as long as we have that methodology, which is a key part of how these pricing constructs are calculated and built, will ensure that the all-in pricing remains fairly consistent through the different benchmarks. Next question is, the bank that is offering the deal will quote their own margin. Gautam, do you want to add some details around how we look at margin today versus what's going to change moving forward?
Sure, Abhishek, thanks. See, the pricing construct as such remains the same between the two periods. I mean, if you look at the LIBOR world, where we are having our benchmark and the margin as it's quoted today, and it's also contractually agreed within typically inside the contracts. That same concept carries on in the post IBOR world also. The only difference around over here is the fact that the RFR rate, being a pure risk-free rate, is just a forward expectation of what the term RFR of that overnight market is looking, and the margins would also be similarly adjusted in there, but they would also remain constant as has been agreed inside the contracts between you and the bank as such. So in terms of overall pricing, depending on how many of drawdowns you would like to do, the margin as such would remain consistent throughout the period of the drawdown, as well as any multiple drawdowns till the time the contracts again come up for renewal. So from that perspective, you can also expect a little bit of consistency in the pricing constructs between what we have today and how these are going to look like in 2022 and beyond. Back to you, Abhishek.
Thanks, Gautam. The next one is on the credit margin. How's the credit margin worked out? Look, the credit margin calculation remains fairly consistent. As we mentioned in some of the earlier slides on the pricing construct, the benchmark moves, which means the credit element is no longer part of the benchmark, which is LIBOR, as it soon starts to cease to exist. As our benchmark moves to a risk-free rate, that means the credit component will be built into the margin. And the credit margin calculation is fairly in line with how the bank would price any other transaction. It's a function of the product, the loan, the cost of funding in the market, the macroeconomic situations, who we're dealing with. And I would recommend from a client perspective, please feel free to reach out to your respective RMs on the particular deal or particular facility that you have with the bank, and we will be happy to share with you all the details around pricing and the respective constructs, and they provide you with the necessary breakdown so that you have the necessary pricing information. The next question is on legacy contracts which mature before June 2023. See, for floating contracts which mature before June 2023, I don't think we need to remediate them on US dollar LIBOR because one, the maturity date is within the period where US dollar LIBOR is available for us to reset. The only case where we would need remediation is if we have contracts which are floating in nature, i.e. where the LIBOR benchmark reprices at a certain frequency, and if the ultimate maturity date is beyond 30th of June 2023, then in those cases, I would encourage you to reach out to your RMs who will be able to work out with you what, if any, the pricing change should be to accommodate floating transactions which go beyond June 2023 and which are using LIBOR today. And we will be able to work out what that pricing construct would look like till the maturity of the transaction where US dollar LIBOR ceases to exist and we need to continue to price you using Term SOFR. The next question is, can Term SOFR resets be hedged in the market? Is there liquidity to hedge it? Gautam, you want to provide some insights on this one?
Sure, Abhishek. Thank you. Yes, the Term SOFR rates definitely can be hedged in the market. The service provider for Term SOFR, which is endorsed by the ARC, is CME. The way CME also calculates these forward-looking rates is based on the 1 month and 3 month CME futures that are already transacted and executed in the market. So there is already that underlying liquidity in there. Now, liquidity is also a function of how much it is going to be used in once we transition away from LIBOR. So as and when contracts are being renewed and the transition has already happened away from LIBOR into Term SOFR, the liquidity in these Term SOFR market is also going to consequently increase. So that would make over a period of time, the liquidity would be expected to progressively increase and the market to eventually, given that at this moment, the Term SOFR rate is the preferred option, even by from a regulatory perspective, it should have sufficient amount of liquidity for us to continue hedging them for the tenors that are already being published. The only place where there is a little bit of discussion going on within the industry itself is for the 12-month tenor point, and we do expect the ARC to come up with their recommendation on its usage. But for the tenors that are already being quoted and published in the market, there is sufficient amount of liquidity for us to look at it from a hedge perspective as well. Thank you, Abhishek.
Thanks, Gautam. Just like to remind everyone, as we go through these questions, feel free to provide more questions. We have about 10-12 minutes left in the presentation, so we would be happy to take more questions because we do have sufficient time. Please feel to fire in all your questions that you have. With that, I'll move on to the next question, which is, what is the basis to determine the credit and liquidity premium? Will it vary from bank to bank? Yes, moving forward, as we move to a risk-free rate, I would expect each bank to have its own methodology. I think the principles could be fairly consistent, but it'll be difficult to comment on each bank's. I would assume each bank would have its own set of methodologies in terms of what the pricing looks like. I can talk from our perspective around, generically speaking, as we covered earlier in the slides and through these examples, the idea is the benchmark has to move from LIBOR to RFR in line with the market expectation and the regulatory expectation. And while the overall principle is to ensure that the all-in pricing remains consistent and reflective of the liquidity situation in the market, and that will, like it does today as well, to be fair, continue to drive what these liquidity premiums or margins need to look like. So the underlying principles don't change. where that mathematical calculation construct breakdown happens, that changes where more of the heavy lifting on the credit and liquidity premiums will now be built into the margin instead of the benchmark rates, because the benchmark rates will be risk-free rates. And as LIBOR ceases to exist, or as it moves toward its natural cessation of over the next year or so for US dollar, of course, in that cases, I would expect the RFR liquidity to continue to build more and become a stronger benchmark. But in the meantime, I would expect there would be a period where you will continue to use other market indicators such as other credit instruments or LIBOR by itself to determine what the all-in pricing should look like. And then keeping in mind what your base RFR rates is, accordingly determine what should be the appropriate credit or margin spread to be added there. Hopefully that helps. Moving on to the next question from Mark again on term rate versus compounding in arrears. They understand that the market in GBP will go towards SONIA compounding in arrears, whereas the dollar market will move towards term rate. Is that a fair assessment? I think it's dependent on the product as well, Mark. I think on US dollar, there's a fair steer from the regulator around use of SOFR, both overnight and term, to price most of our transactions for US dollar. On GBP, the regulatory guidance has been a little more prescriptive around where term SONIA should be used. I think view is for trade products as well as for within the trade products where we need discounting. The hope and the expectation is that we will be using term SONIA to price our clients, because that will ensure that we can provide a term structure which is LIBOR-like, even though we are moving to term SONIA in light of the regulatory guidance and meeting the regulatory obligations, while still able to ensure that we provide our clients with the necessary visibility on what the interest rates look like and provide them with the necessary cash flow certainty. Gautam, anything you want to weigh in on this point?
Nothing further to add on this one, Abhishek. But I would just like to make one quick point on this. The market conventions for all the term RFR markets, they're obviously constantly evolving. Now, of course, with US dollars, as Abhishek mentioned, there is a lot more broad scale usage of those term rates. And as things stand, yes, the markets are looking at arriving at the 3-month term rate as a pivot point. In the term SONIA market, where the use cases are quite restricted, broad scale usage of term rates has not yet been widely endorsed in the industry. But for products that are very much dependent on those, we would definitely look to be using the term rates as they are quoted in the market. Now, the underlying market for term SONIA, at least in particular, is essentially the OIS market, which is also in a way a forward-looking market over here. So whatever are the underlying conventions that are there in the overnight SONIA IRS market would naturally be applicable inside the term SONIA reference rate market as things go along. Once there's, of course, a fair amount of usage for term rates across the globe, then we would definitely see some amount of consistency in, or rather we would hope to see some amount of consistency in how these rates are being calculated and what the actual market conventions are. Thank you, Abhishek.
Thanks, Gautam. If you don't mind, Gautam, there are a couple of questions. I'll try and combine them around usage of Bisbee and how Bisbee would differ from term SOFR. Is something we've discussed with some of our industry body colleagues as well, Gautam. Any insight you can provide on the Bisbee versus term SOFR?
Sure. Thanks, Abhishek. So Bisbee essentially, or for that matter, even Ameribor and some of the other indices that are coming out or evolving in the market, these are all purely credit sensitive benchmarks, which means similar to LIBOR, they have in them an embedded credit premium. And that is where I believe the divergence is also between the term RFR market as such versus these credit sensitive benchmarks. The RFR market is purely reflective of the expectation of overnight rates that it would be over the term structure of the particular curve. So if you have a 1 month term SOFR rate, it's essentially just telling us where the overnight rates would land 1 month down the line. But the underlying market still remains a pure risk-free rate market. Whereas if you're looking at some of these credit-sensitive markets, and in particular the way they are also calculated, the underlying transactions, although may be based on executed transactions, they still are in a way reflecting some of the instruments that are being issued by banks like CD, CPs, and things like that, in order to determine these rates. So there is a certain component of credit sensitivity already embedded in those rates, and well, the regulators have kind of expressed that market participants should exercise caution when they're looking to use some of these credit sensitive rates. The markets at this moment, there is still a bit of uncertainty in terms of whether there could be broad scale usage of these credit sensitive rates, and in certain cases there may not even be an underlying derivative market for us to even hedge some of the positions that you would take. Some of these things are quite important to take into consideration before looking to use some of these credit sensitive benchmarks, as opposed to where the market has been, where the regulators are recommending the markets to move, which is to look at the term RFR market as such. Thank you, Abhishek.
Thank you, Gautam. Thanks, very helpful. There's another question from Syed on how can we be uniform on the credit and liquidity premium charge in a syndicated loan. I think that's a fair insight. I think it's a function of who's the lead financial institution in these kind of syndicated facilities. Look, it would make sense to have a detailed conversation based on what the actual facility where you're asking the question from is, because there could be specific nuances that we need to understand on the underlying syndication facility before we get into the specifics of how the pricing construct needs to be adjusted based on what it is. So I would encourage having a offline conversation around what should be the appropriate repricing conversation that needs to be happen depending upon the details of this facility. So I would encourage us to have an offline conversation to get into these details. I don't see any other questions for now, and I think we've covered most of the questions we wanted to and that have been asked. I would just reiterate that if you have questions after this call, feel free to reach out to ourselves and we'll be more than happy to provide you with details. For all our clients on this call, please feel free to reach out to your RMs and they will be more than happy to provide you with the necessary details, and where additional information are required, we will make sure that the additional questions that come through post this session are answered. I would just want to remind and encourage everyone to please actively reach out and have conversations with clients, and for our clients to reach out to our RMs to have active conversations on what repricing should look like, particularly in an accelerated manner if we have existing facilities or drawdowns in Euro, GBP, JPY, and CHF, to ensure that we can transact as we do today in a fairly smooth, transparent manner going into 2022. That's really important, and it'll ensure that we can use the next 2 months to one for these 4 currencies, reprice and redocument, and prepare ourselves for US dollar going into 2022 to make sure we work with our clients and make sure we are providing necessary details and then following the process of moving the facilities over from IBOR-based pricing language to RFR-based pricing language. If there are no other questions, then I think we've come up to the hour almost anyways. I just want to take this opportunity on behalf of my colleagues and the bank to thank you for your time, for attending this session. Hopefully it provided you with some details and some additional details. This deck and additional reference material in this deck will be shared with everyone post this call, and I hope that helps you understand more of this. You can use that time to digest the information provided here, and if there are follow-up questions, please feel free to reach out to us. Let's have a conversation, let's have a dialogue, and hopefully we continue to work with you as we did today. Thank you everybody for your time and look forward to speaking to you again soon. Thank you.